for joining us today. Again, this is a quarterly market insights we do here at Carrington to give you, our views, what we're thinking, looking forward, but also reflecting on the quarter that's just gone. As always, I'm joined by Mo, our head of investments, and today for this webinar, I'm also very happy to say that we're joined by John Mullins from Wellington Asset Management. John I'll let him give a bit of an intro, but he's an investment director at Wellington on the multi-asset sort of solutions desk there. In terms of how we'll take the webinar, as always, we'll give a recap of the quarter just gone, sort of some of the things that did quite well there and other things that didn't do well. We'll look forward into the year ahead. There's a lot going on this year, things like geopolitics, the inflation outlook, and also things like presidential elections. We know there's a very busy year going forward for them as well. And as always, at the end, we'll give time for Q&A. So please do send in your questions if you have any. There's a function that should be either at the bottom or the top of your screen. Allow you to do that. So before we get into it, John, I guess I'll ask you, if you don't mind, give me a bit of introduction to yourself and your role at Wellington and perhaps your career path today.
Yeah, thanks, Thomas, and thank you for the opportunity to come and speak with you and your clients today. So my role, I'm, as you said, an investment director on the multi-asset solutions team at Wellington. What I do is largely act as a gateway for clients into Wellington as an organization. We put together bespoke investment solutions for institutional clients, for wealth clients, spanning across various different asset classes, designed to be customized to risk profile, to return expectations, and other client-specific considerations. I spend a lot of my time out on the road speaking to clients about Wellington's views of the world, our asset allocation views, our views around specific single asset classes, and helping clients think through their own portfolio construction and strategy design. So somewhat acting as a kind of thought partner or kind of quasi-consultant with our partners, again, across various regions, across various channels, and client types. My background, I'm a little bit of an anomaly in that I've always been a multi-asset person. I've never been a single asset class person in my career. So I started my life in the middle and back office of what was then Merrill Lynch, and then at Deutsche Bank, and then I joined the multi-asset group at BlackRock, where I spent 5 years on that team. I ran then some multi-asset portfolios at Santander, largely focused around the UK and European retail channel, and then before Wellington, I was at PIMCO, where I was also a multi-asset investment specialist or product specialist. So very much multi-asset through and through. So I can speak across a wide range of topics, but maybe not as deep as some of your equity or fixed income specialists. But I'll do my best.
Yeah, cheers. Thanks for that, John. And just for your guys' reference, we've met John before. He's spoken at our investment committee meetings in prior quarters, and we also own the Wellington Fund in our core portfolio. So just to give you an idea of the relationship we have with Wellington and Carrington ourselves. John, I'll come straight back to you then, actually, because I think first of all, it's good to talk about the quarter in review and what's happened. Perhaps you could start maybe on a higher level, looking at the sort of some of the key themes that influenced the quarter and the subsequent performance of the different asset classes.
Yeah, absolutely. So I think it's probably important just to take a step back and kind of try and remember what were the prevailing narratives as we entered the year, right? So we came into 2024 with this kind of profound belief that disinflation was happening very, very quickly and was going to continue. And because there was quite a lot of conviction in that, the market was pricing pretty aggressive rate cutting path from the US Federal Reserve, but also the ECB and Bank of England. And at the peak, we got towards 6 or 7 rate cuts being priced in by the Fed. There was also a kind of still quite a lot of concern around recession risk, I think. And then the third kind of core theme was this idea that the Mag 7 was going to kind of carry the equity market, and the Mag 7 was going to do well, but because recession risk was elevated, you weren't going to see a big broadening out of that equity market participation. And so the asset allocation playbook at the time was own duration, because the Fed was going to cut rates 7 times, and starting yields were attractive. You probably want to be long equity risk, but mainly in the US and mainly in that kind of Mag 7 or tech-related sector. And you probably don't want to own things like commodities because inflation is past, inflation is behind us, and kind of this kind of disinflation theme was not stoppable. And so what ended up happening, like a lot of that turned out to be quite wrong, right? So the market's now come full circle because inflation seems kind of stuck at 3%, more so in the US than necessarily in Europe, and the UK kind of hanging in between the two. But the disinflation theme has kind of run out of steam somewhat. And so the markets had to reprice a lot of those rate cuts. And so because of that, you've seen negative performance from big parts of the fixed income universe, specifically government bonds. The second piece, obviously inflation, it's now kind of consensus that we're kind of here now. Most of the disinflation momentum is behind us. We're kind of at this 3% level, and it's going to take quite a bit longer than people expected to get back down towards central bank targets. And thirdly, I think that what's really interesting has been how much the equity market has broadened out, right? So if I look over the last 2 months, for example, the S&P 500 equal weighted, which is like a kind of equal weighted S&P 500 relative to the S&P 500 kind of pure, which is a market cap weighted index, there's very little in terms of performance differential between the two. So you're starting to see a bit of a broadening out of equity market momentum, which is kind of pretty reassuring. You see sectors like energy doing well, financials are doing well, and that's encouraging, because that's really what people wanted to see, was like a broadening out of that equity market rally. Commodities have done really well, which is I'd imagine quite a few people have been caught offside on that, because I know there was a lot of reallocation away from commodities into duration through last year. So gold specifically, I mean, gold's up 20-odd% in the last 100 days or so. That's a big move by kind of relative standards for the gold market. High yield has outperformed, IG's done okay, and core rates have underperformed. So they're the key highlights for me. It's also good to see like Japanese equities, European equities all doing fairly well. So it really hasn't just been about the Mag 7. There's been a lot more going on. There's been plenty of opportunity to make money in the market, I think, over the recent quarter.
Yeah, I think sort of a theme sort of towards in the last quarter and coming into this quarter, I guess, has been, as you touched on at the start, there's sort of this US growth exceptionalism relative to other regions like the UK and the EU, as you touched on. What have been the sort of main drivers that have kept that momentum going in the US particularly, and then perhaps we can look at talk about the UK and the EU as well?
Yeah, so I mean, especially as it pertains to US growth, it feels like every quarter for the last year, everyone's been saying, right, over the next couple of quarters, US growth is gonna fall off, and it just hasn't happened. I mean, the consumer's in pretty good shape. Obviously, the earnings tailwind from the Magnificent Seven and the AI theme is supporting forward equity or earnings per share expectations for next year, which is helpful in terms of keeping the equity market momentum to the upside. And I think a lot of this, I think what surprised people last year has been like the economy seems just way less sensitive to higher rates. And so we're trying to unpack why that is. It's kind of easier in hindsight, but it is worth discussing. I mean, household debt is just lower, right? So that means the transmission mechanism is naturally less. A lot of people say either own this in the US, either own their houses outright or on these kind of 30-year mortgages where they've kind of locked in this low rate. And even in the UK, we see the same, right? A lot of people own their houses outright. The stock of private debt just isn't that high, and so that creates a naturally lower sensitivity to interest rates. And also, I think the counter to that people would cite is like, well, government debt is way higher, and that's true. But a big chunk of the increase in government debt sits on central bank balance sheets. So again, that slows the transmission mechanism of higher rates. If we look at Europe, European growth has been slower, especially in places like Germany, but actually pretty good in places like, well, I'm from Ireland, and growth's been pretty good there, but also Spain. A lot of the peripheral countries having fairly decent growth as well. So our view is that growth in Europe has kind of troughed and should improve as we move through the year. Similar with the UK. I mean, the UK had, especially in terms of the inflation problem, in Europe, it was really about energy prices, and the US, it was really about like tight labor markets, and energy prices were less of an impact. The UK kind of had the worst of both worlds, where we had the energy price impact and the tight labor markets. But again, expectation is for UK growth to pick up as we move through this year. So the outlook from a macro perspective is pretty good. And then your question as an investor is, hey, well then what's priced into regional equity markets relative to the growth expectations as we move through this year?
Thanks for that. Mo, I guess I'll come to you. Sort of any additional comments from what John mentioned?
No, I think and afternoon to everyone. Thank you very much for joining us today. No, very similar comments. A lot of those points I had noted down myself in terms of, what the markets were thinking coming into the start of the year and how things unfolded. And I think we've made a lot of comments on our previous commentaries around some of those points. Maybe I think what might be helpful is translating that back to our portfolios and perhaps performance over the quarter. So, for example, John mentioned that you probably wanted to have a decent amount of allocation to the US equity markets, which is, as many of you who would have been reading our quarterly commentaries has been the case for us, and that remains our largest allocation on the equity front. So, and we have had a fair bit of exposure to the Magnificent Seven companies as well as others, and that certainly stood us in good stead last year, especially in Q4 and coming into this year. So all portfolios delivered positive returns over the quarter. And again, as John mentioned, it was specifically the government bonds in the portfolios that came under pressure, which wasn't a huge surprise, actually. I think the markets have got ahead of themselves in terms of the number of interest rate cuts that are pricing in at the start of the year. And there's been quite an aggressive repricing since then. But, we remain invested in parts of those markets and expect that they will appreciate moving forwards throughout the course of the year. So, but I think also worth mentioning that, and maybe we're going to quickly go into outlook here, but, we have been, I'll say, taking profits, maybe is the right way to put it, in some of those exposures that we had. So we had some direct exposure to some technology funds. Naturally, we're very skewed to a lot of those companies that did very, very well. We've decided to take profits from those over the last sort of month or two. So, and then maybe we'll move on to next, because I'm finding myself going into outlook already.
Yeah, well, I mean, perhaps, John, I'll just come to you then quickly, because as Mo rightly touched on, our view is that, especially US tech valuations are looking quite expensive. Do you guys share a similar view there?
I think so. We're overweight equities at the moment. We're overweight US equities within that. I would make a few points. So, firstly, the equity market has pretty much gone straight up for since October last year. It's been a very aggressive rally. You've had very little in terms of 2 or 3% corrections. I think probably no 3% corrections. We might be verging on 2 or 3% over the last week or so, but by and large, it's been a very smooth ride. Usually, most years you get a correction like call it 7 to 10%, and given how long we've gone without that kind of pullback, I think if you wanted to be very tactical, you could say the market is exposed to that kind of a kind of healthy, what the market calls a garden variety correction. And my view would be that would be very healthy for the equity market, and it would set us up nicely into the end of the year. So it depends on how tactical you want to be. Our process works over like a 12-month view. And on that view, I think, yes, the equity market, the US trading at like 21.5 times, it is expensive. But usually, so firstly, valuations can just stay high and continue going higher. They're not mean reverting over short periods of time, right? And usually it takes a kind of sudden shock or fear of a recession to try and bring about that correction in valuations. In terms of the interest rate dynamic, like we've gone from 7 cuts priced to 2, and the equity market doesn't really mind very much, and that's a risk. But I think there's the discount rate and the earnings that rate is discounting, and the market seems to be saying, hey, so long as the earnings continue to grow, they're growing it to such a magnitude that we don't mind necessarily if they're getting discounted at a higher rate. So I think that just to sum that up, valuations can stay expensive for a while. They're not necessarily mean reverting over the short term, and they're at the moment there probably is a little bit of a risk of a short-term pullback, but into the end of the year we'd expect equities to be higher. The one other thing I'd note is in some of the conversations with clients, I hear like, hey, we've hit all-time highs. Is this really a good time to be investing? I think the point would be like, actually, if you look historically, the market spends a lot of time near all-time highs, right? It spends about 50% of the time within kind of 5% of that all-time high. And buying at all-time highs isn't necessarily a losing strategy, right? There's a lot of, especially in a market like this where like momentum is pretty strong, the all-time highs or high valuations in and of themselves aren't sell signals over a, and I say signal loosely there, but aren't necessarily reasons in and of themselves to not want to own equities on a 12-month view.
Yeah, no, I certainly tend to agree. I think it obviously depends on the wider environment and what's going on. So I guess then, you spoke about some of the risks that or some of the things that could sort of be a negative to equity. So let's sort of look into that a bit further then. I think the first one, a lot of people's mind is inflation, which seems, the most recent data seems to be reaccelerating slightly. Perhaps you give your thoughts on how you think inflation might trend over in the next 12-month view.
Yeah, so if you look at inflation over the last 6 months, we're really stuck around this 3% level in the US. And it's important to put that on the context of where we were a year ago or a year and a half ago. We've come down a lot, right? So from 9% to 3%, that's good, right? And it means the market can kind of, at least to some degree, price out this kind of 1970s tail risk runaway inflation scenario. To avoid sounding cliched, there's a lot of difference between 3% and the sub 2% that we had since the 90s, right? And the market is slowly readjusting to that possibility that we're not going to get back to those levels, and we're going to be in this higher for longer inflation regime that doesn't need to be 8%, but also isn't 2% and kind of looks somewhere in the middle. And the market's trying to price that, which is why you see this kind of volatility in rates, right? The US 10-year has gone from all the way back up to 4.5, a little bit higher, in a very short space of time. And so the market's trying to price that. Our view is that the risk for inflation as we move through this year is probably slightly to the upside in the US specifically. Just given a lot of the disinflation is done, things like insurance costs, things like shelter are just proving much stickier, and growth is still really strong. So it's hard to see kind of continued disinflation. And that means the market's pricing 2 cuts. the risk to that is probably balanced to the upside of no cuts. And if you're looking at it, growth is doing well and inflation is still above target, the central bank really needs to find more of a reason if they're going to embark on a kind of aggressive rate cutting cycle from here. So Europe's a little bit more different, or a little bit different in that we think the ECB could move before the Fed. Disinflationary pressures are pretty broad based across countries, across kind of areas of the basket within Europe, and the economic growth pictures worse, right? The growth in Europe has significantly underperformed growth in the US in terms of realized growth and expectations for future growth. And again, with the Bank of England kind of stuck in the middle, a little bit more in terms of inflation pressure. But again, we see inflation picking up really across the board, US, UK, and Europe through the year, but Europe probably in a bit of a better situation in terms of how much higher inflation could go.
I mean, if you saw a scenario where inflation was trending higher and growth was remaining strong and rate cuts were priced out entirely this year, could you ever see a scenario where, especially in the US, the Federal Reserve could actually hike rates further?
Never say never. I mean, it does. I think the bar to hiking rates is pretty high. So I think they'd want to see inflation, that core PCE, start to move like towards 3 or even higher than 3, even towards 4. I mean, just given that inflation has come down quite a bit over the last 6 months, real rates have actually kind of systematically tightened because Fed funds has kind of stayed, the cash rate has stayed where it is, and the inflation rate has come down, which means the real rate has moved higher, right? So we're in a tighter real rate environment than we were 6 months ago, and so for that reason, I think even if inflation was to pick up a little bit, central banks are more likely to say we'll keep policy where it is for a period of time, versus going towards actually hiking. If they did, or even if the Fed communication starts to move in that direction, that would be a significant downside risk for equity markets, in my opinion. I think if you were to see that, you'd be talking about a pretty meaningful correction, because it starts to put higher for longer back on the table. It would also signal that the Fed is kind of worried about inflation going to 5 or 6 or even all the way back up to 8 or 9. I mean, that would be a pretty bad environment for most asset classes in the near term. So I wouldn't rule it out, but it wouldn't be the base case.
Yeah. Okay. Yeah. No, I'll come to you there. Any sort of additional thoughts there?
Yeah, no, just touching on a couple of things John mentioned, specifically with regards to the number of interest rate cuts that are now being priced in. So we've gone, as John said, from approximately 7 to now roughly 2 for the year from the US Federal Reserve. And the only market that's really adjusted for that are the government bond markets and treasuries, etc. Equities haven't really budged at all. And so yes, there's an angle of, earnings growth has been okay, and so it's all fine. But we also think that actually inflationary pressures are actually to the upside for the year. And so let's just say we enter a situation where the remaining interest rate cuts are priced out. What would that mean for equities, and especially those that are at the sort of higher end of valuation? So we saw what happened in 2022 in that scenario, and we're leaning maybe slightly more cautiously in that respect, and which is why we've been sort of trying to take down the overall sort of valuations of the portfolios to insulate us from that potential. So and the other thing actually I didn't mention earlier was that something else, because as John said, something that's expensive can carry on being expensive for a prolonged period of time. One other thing we do pay attention to in the portfolios is investor sentiment and flow, investment flows. So we have noted that investor sentiment, certainly in the US, is what had certainly reached quite I don't want to say extreme, but very high levels that matched those in sort of Q4 2021. So it's something, again, we're quite mindful of that. When you get an aggressive sort of move from the retail end of the market, that makes us slightly more cautious, and so that coupled with some of the points that John mentioned has just meant that we're just taking the foot off a little bit in some of those areas and trying to insulate portfolios against any upside risk in inflation.
Yeah.
And I just add to that. I mean, if like we are a little bit overweight equities, but what stops us being very overweight equities is as Motion mentions. I mean, we're pricing 10% EPS growth next year for the S&P. I think 12 or 15% for 2025. That's a lot, and that's baked into the S&P 500 at I think roughly 5,100 now. If those earnings disappoint and you get upside in inflation, I mean, there is risk that you see equity markets adjusting. And as I said, most years you're going to get this kind of 7, 8, 9, 10% correction along the way. So is taking a bit of risk off the table, having a bit of dry powder so you can tactically reallocate at better prices. I mean, it seems, again, it depends on your investment horizon, but it certainly seems reasonable.
Okay. I think that the second sort of, I guess, headline theme that we were going to discuss was geopolitics. And I think that's something that can, or may have a direct impact on the inflation outlook. Depending on, we don't know what's going to happen in the Middle East, which has been the most recent sort of escalation. Whether that goes further, we're not sure. But I think what we can be sure of is that if there was some sort of escalation, certain parts of the market might be sort of negatively impacted by that. And I think inflation is one of them. John, could you sort of speak to that a little bit and just give us your guys' view on the geopolitical sort of outlook and the impact that would have or could have on the likes of inflation and markets more broadly?
Yeah, absolutely. So I think this is personal view here. Geopolitical risk for me is best managed in a portfolio through structural allocations to things that can do well, gold, commodities, where more broadly where you can buy them, perhaps even certain types of protection strategies, versus trying to hedge or time geopolitical risk in an event-dependent way, right? And I think the last 10 years have showed us this, right? Think about President Trump's first victory in the US, Brexit to some degree as well, right? Where like there was an expectation of what the market was going to do based on XYZ outcome materializes, the market ends up doing something different, right? So even if you could predict geopolitical events, which I think is really hard to do, predicting what the market is going to do in those, if those events come to pass, is also extremely difficult. So for me, I like commodities in a multi-asset portfolio context because of this. I think if we look at what gold's done over the last few months, both in terms of rising inflation expectations, but also heightened geopolitical risk, you kind of see gold's role in the portfolio. Even if the drivers of the gold price are very different from one environment to the other, almost its unpredictability is kind of its value in a sense in a portfolio construction perspective. I think a lot of investors through the years have left a lot of return on the table, de-risking ahead of geopolitical events that they don't have high conviction or an edge in. So I'm not saying don't pay attention to geopolitics. Of course, they can present a lot of risk to portfolios, but also just be humble and at least I try and be humble in my ability to predict what those outcomes are and then what the market's going to do on the back of those outcomes.
Yeah, sure. Thanks for that. Mo, yeah, and it'll come to you with the same question.
Yeah, look, I totally agree. It's and John made some very good gave some very good examples with Trump and Brexit, where even if you had known the outcomes, the market reaction was probably going to be totally different, I think, to what most people expected. So in terms of our portfolios, yeah, so we've owned gold for quite a long time and have had a good allocation, and we're currently readjusting that so that we can capture more of expected upside, which we think will come through over the course of the year, and that's more through companies that mine gold as opposed to the gold price itself. And then, yeah, we're broadening out our commodity exposure as well in light of, so, you know, there's been, I mean, we've been talking about commodities for a little while now, and I think we mentioned it in the last webinar and in our previous commentaries that we felt that there was upside risk to commodity prices for a variety of reasons. You know, obviously the longer term one is specifically relating to the energy transition, and lots of commodities such as copper have very good sort of long-term upside potential. But there are other things as well, such as the oil price, and we felt that the oil price is likely to appreciate this year due to sort of supply and demand dynamics. Now throw in the added sort of geopolitical risks that are going around, and so we have been building up our exposure to commodities, and we'll be looking to do so over the next sort of 4 weeks or so, for that exact reason. So yeah, I think, and then yeah, actually the other point John mentioned was with regards to hedging type strategies. So for the portfolios where we can buy them, and they are the ones that we call the core portfolios, which blend active and passive strategies. So this is not just the pure passive portfolios. We have several funds in there that can hedge or protect against unexpected events, which we believe you know, the risk of obviously clearly rising at the moment. So yeah, I think portfolios are shaping up to help navigate any unexpected outcomes in that respect.
Just the only thing I'd add there, I mean, just to reiterate the point around commodities, I mean, if you think the biggest risks to the markets today are inflation and geopolitical events, commodities are the obvious diversifier for that. And if you look, interestingly, at month-on-month volatility in CPI, commodity prices account for about 70% of that. So you really are getting that kind of a nice inflation sensitivity out of commodities to hedge portfolios. And as we saw in 2022, for a multi-asset investor, inflation is the biggest risk, right? Because your equities aren't working, your bonds aren't working, you need something in there. And I've always been a fan of commodities, or commodity equities to get that exposure, such as gold miners, as most mentioned.
Yeah, brilliant. Thank you. I guess, you know, we have, I feel like in that we've touched on some of the thinking about moving forward and areas we're looking at. Perhaps then, just to sort of before we go to Q&A, if you could both sort of summarize then, perhaps John, I'll come to you first, you know, the key areas you're looking at, just sort of as a way to sort of summarize the whole sort of discussion we've had today, moving forward on, let's say, on a 12-month basis, as you mentioned previously.
Yeah, for sure, Thomas. So I think high level, as a multi-asset investor, you never want to be too complacent about the environment, right? So you want to be alive to the risks, and obviously markets have come a long way. But that being said, you want to keep an open mind that, like, at face value, things are pretty good for the economy at the moment. Inflation's probably a little bit higher than you would like, but again, not so much that I think we're in a situation yet where it's going to push central banks to start hiking rates again. So it's an environment, growth is above trend, earnings are expected to grow at a pretty healthy clip. The market's broadening out in terms of the drivers of equity market performance. So it's difficult to be overly bearish in that environment, and so that leaves us a little bit tilted a little bit more constructive risk. Spreads, so like high yield, investment grade credit, again, we're constructive in those markets. Spreads are tight, and by spreads I mean the additional yield above the cash rate or the risk-free rate. They're tight, but I mean, again, short of a catalyst that's going to cause a significant increase in default rates, and given where starting yields are, I think most have made this point earlier, like the forward-looking outlook for a multi-asset investor is pretty good, because for your fixed income allocation, your starting all-in yield is probably the best predictor of your future returns, and all-in yields for high yield, for investment grade, for government bonds are attractive. And I think that's why you've probably seen most participants kind of willing to buy the dip in fixed income, because they're happy to lock in those yields for the long term. And as a multi-asset investor, that's pretty attractive. So we certainly like owning kind of credit risk. We like owning equity risk. We're neutral duration at the moment, just given uncertainty around the inflation outlook, and also given where we've moved to in yields. it's not abundantly clear to me that you want to be over or underweight core duration at this point. And certainly if we see a tactical pullback in equities, which again is probably risk of that's a little bit elevated, we'd be looking at that as a buying opportunity, just given growth over the next 12 months globally. We expect it to improve and be above trend.
Okay. And Mal, will come to you as well.
Yeah, look, very similar. Look, we've been, I suppose, overweight equities for quite a long time now, and it stood us in good stead, especially because we had a good allocation to the US markets. I think we're just sort of slightly pulling back on that a little bit to maybe more of a neutral position. That doesn't actually mean a huge amount for us, because we try to be as invested as possible, because ultimately, this is about long-term investing. So there is a sort of small clip, and that's really focused on bringing in some more commodity-like exposure, which, so they don't really, not always, but they don't always behave like, let's say, the US market. So yeah, we're looking at ways to diversify a little bit out of equities, but apart from that, yeah, we remain constructive, barring any sort of unexpected surprises.
Yeah, brilliant. Well, thank you both for that. It's really helpful, and hopefully that gives you guys listening good idea of what's happened, what we're thinking, and how we might be positioned moving forward. Got a couple of questions. I'll jump into the first one. Something we actually haven't really spoken about is sort of Asia as a region. I think with all the other sort of regions, there's a lot of noise going on there, and maybe Asia sort of just slipped away under the headlines a little bit. John, could you perhaps share your view on China? Previously that's been quite a contentious topic. Regions like Japan has done quite well. We appreciate to hear your thoughts on those two.
Yeah, for sure. So in terms of Japan, it does seem like the Nikkei has broken a kind of 30-year high. There's a lot of kind of governance reform going on in the Japanese market to make companies a little bit more shareholder friendly. That's boosted by kind of better inflation dynamic and the ending of unconventional monetary policy, albeit gradually. So we're pretty constructive on Japan, on that secular Japan story. We took a little bit off the table. We've been overweight Japan for a while, so we took a little bit off the table. We remain overweight, but a little bit of profit taking more recently. But I think, as I said, I think that structural story is intact for Japanese equities. China's been a really hard place to be for investors over the last 3, 4, 5, even 10 years. There was a lot of good reasons to get allocated to Chinese equities kind of over the kind of 2019, 2020 period. Europe doesn't make solar panels, China makes them, was one narrative. And I think, again, that made a lot of sense because it was true. Also, investing in areas that are kind of aligned to China's strategic priorities, such as healthcare, AI. Again, these were kind of fairly sound investment theses, but they haven't worked. And so a lot of that's down to the regulatory environment in China, which has become, frankly, just kind of less shareholder friendly or more unpredictable. Deleveraging within the Chinese economy presents further headwinds for equity markets. And so the problem, all that points to being underweight Chinese equities, right? You've got significant regulatory uncertainty, low confidence within the economy, deleveraging. The flip side of that is, and of course you have geopolitical risk, which again, very hard to quantify, but it's certainly something that has to be considered when investing in Chinese equities. The flip side of that is Chinese equities have been beaten up really badly for a long time, and valuations are it's the cheapest major equity market in the world. And if you're managing a portfolio, you have to be alive to both upside and downside risk, right? Because it wouldn't take a lot, given how depressed sentiment is, for things to get just a little bit better in China, and the Chinese equity market goes on a bit of a tear. So for me, it's be underweight in the near term, but you got to size that underweight sensibly, right? You don't want to be running extremely large underweights because the Chinese market could move 10% relative to global equities in a very short period of time, and then your benchmark relative performance is going to be significantly impacted by that. In order for us to get long Chinese equities, I think from here we'd want to see an improvement in global investor participation in Chinese equities, so global allocators reallocating. Some more confidence around it turning in the regulatory I think it's some improvement in the trajectory of the regulatory piece. I think the deleveraging story is just a little bit more long term, and so it's unlikely we're going to see much change there. So cautious in the near term, but sizing those positions very sensibly in terms of risk allocation.
Yeah, Mel, I'll come to you because we've had exposure to Asia and China.
Yeah, I mean, just conscious of time, so I'll very quickly add that, and maybe China's more interesting. So yeah, we've taken the other side of the coin in that we felt, yeah, there's the Chinese negative headlines have been around for a couple of years now, and that's certainly been reflected in their stock markets, which have gone down very, very significantly. And as John mentioned, probably the cheapest major equity market in the world at the moment. And so, sentiment's very, very negative. Now, I mentioned earlier about, we do pay attention to sentiment. And you could argue that maybe it's gone too far into sort of the negative territory. And so your risk reward is probably more in your favor in that any sort of less negative view or news that comes out of China, as John said, could lead to a very quick and material move upwards. So from a risk reward perspective, we think it's probably in your favor too, on a sort of 12-month view, to have an allocation to China. So with the in our core models and through the active funds, so we, just for clarification, in Asia we only buy active funds, we don't buy passive. Obviously that's different for the passive portfolios where we have to buy passive, but for the core we only buy active, and the managers there, one in particular, is seeing this as an opportunity and has been, as China's got weaker, they've been leaning into the names that they like and are now overweight. So we have got a slight overweight to China, and we think that at some stage we think that could pay off whenever sentiment becomes any less negative to the region. Yeah, that's a very quick, I think, answer to allow some more questions to come in.
Yeah, we've got a couple more that come through. Again, John, I'll come to you first for this one. Just going back on the geopolitical risk and sort of the impact of this on markets. Do you think that the current sort of market pricing of rates is taking into account the geopolitical risk and the Middle East tensions? And do you think sort of the market's too eager for rate cuts, perhaps?
Sorry, the question was: is the rates market pricing in geopolitical risk?
Yeah, and the sort of potential escalations and tensions in the Middle East.
It's tough because a geopolitical risk event, being a risk event, should support rates, right? So you would hope you would see this kind of flight to quality. It should support the dollar. It should support rates. But because the inflation dynamic is such that it is at the moment, any sort of geopolitical risk that's going to cause a resurgence in energy prices is probably going to be rates negative. And so if, again, I kind of pull back to my other point, it wouldn't be clear to me that rates are the best geopolitical hedge today. I'd actually probably own broad commodities or gold. Now gold has done very well, so maybe broad commodities are a better kind of more diversified hedge. But so it's just the link between geopolitical risk and the rates market is confused by the inflation dynamic at this point. And if we think about like what's making central banks a little bit nervous, it's been the rally in commodities this year, right? It's the energy disinflation was a big part of the narrative, and that's turning around. And part of that is geopolitical, and part of that is just a better growth outlook. But it is, I think, so it kind of a roundabout answer to your question, but I don't think the rates market today it knows how to price that geopolitical risk because of those conflicting factors.
Okay, yeah, that's a good point. And we've got one more question we haven't touched on too much, but about the UK. Are you concerned at all with the sort of pessimism in the UK market and the London Stock Exchange? Because there seems to be a lot of, I mean, there's a lot of negative headlines and news flow around, UK listings in the UK, and it'd be good to hear your thoughts there.
Yeah, so not a strong view on UK equities within the team, but I'll kind of come back to some of Mo's points around China, right? I mean, the UK equity market is cheap and largely disliked, and that can provide an attractive buying opportunity. UK equities generally in a multi-asset portfolio, you're getting some decent sector diversification in terms of relative to the US market, right, which is very tech concentrated, and you're getting a different factor footprint from UK equities. You're also getting, as you guys are well aware, like a pretty good global revenue footprint from a FTSE 100 type exposure. So again, we don't have a strong view on UK equities, but I could certainly see a valuation case and a sentiment case in the UK market, but probably something Mo has a stronger view on than I do.
Yeah, I mean, one thing we do, so we own a couple of active funds. We also own, by the way, the FTSE All Share Index for those exact reasons that John just mentioned, that it's actually quite a good diversifier for portfolio construction because of the US exposure is very sort of tech dominated. And so it's actually nice to have the all share with the energy, materials and financials, etc., to offset the tech. But we do own some active funds as well. And one question, well, the question I ask every single UK active manager I oversee is, are you concerned about the UK equity markets? And certainly the shrinking number of equities on listed equities. So far, still, the answer has been that they remain happy with their investable universe that they look at, and that they are still finding plenty of opportunities. So from their perspective, there's no concern just yet, but it's definitely a question I ask them at every single meeting. So yeah, look, we are, again, yeah, as John mentioned, we do try to think of the portfolios in terms of there's some things that are what we maybe deem to be quite expensive, or there's lots of optimism around those particular parts of the market, such as the US. And so we like to try and offset that a little bit and try and look for opportunities elsewhere. So China being one, the UK being another, where you can get stocks at much cheaper valuations. So it's a sort of balancing act of trying to find remaining investing in the areas that may be optically expensive, but also trying to diversify with cheaper areas of stock markets around the world.
Great. Well, conscious of the time, so thank you both for answering those questions and also giving us your thoughts. John, thank you very much for joining us. It's really great to get you on, and I'm sure our listeners are really sort of appreciate hearing your views. So thank you, and guys, to all of you who have joined, thank you very much. If you have any other questions, of course, please feel free to email us directly, and we'll try and get back to you with any responses. But for that, I'll say thank you very much for joining, and enjoy the rest of your afternoon and have a good week.
Thank you. Thank you very much, John. Thank you.
Bye-bye. Thanks, guys. Bye-bye.
Thanks.